In the past decade, we've seen fast-paced developments in the crypto universe. It is a very ambitious setting that has evolved rapidly alongside the traditional monetary system, composed of national treasuries, central banks, and commercial banks. This parallel digital environment is mysterious, dynamic, innovative, uncertain, and unregulated. Today we'll have a sneak peek into one of the possible versions of the future monetary systems where decentralized finance and central bank digital currencies coexist.
One of the most notable areas of innovation in the last few years is in cryptocurrencies. As you know, crypto wants to cut out the middleman and introduce a decentralized monetary system. This is the idea of decentralized finance, or DeFi, and of a decentralized internet as of Web 3.0. So the first shortcoming is that crypto is not safe or stable. Cryptocurrencies perform pretty poorly as currencies, and stable coins are not actually stable. So those are key problems. So behind this, the system is not accountable. It has morphed into a parallel financial system that circumvents regulation. It is often claimed that crypto is more efficient, that it will democratize finance, or that it enhances privacy. However, we don't see this in practice, at least not to date. So when a blockchain gets congested and its transaction fees go up, users move to other blockchains that are still cheaper. This is exactly what we observe in this slide. When Ethereum congested in the mid-2021, other blockchains enter into the scene. And this results in a fragmentation of the crypto sector with many competing blockchains and coins. And this means that crypto does not benefit from network effects. In addition, a lack of interoperability between blockchain introduces the need of crypto bridges and additional security risk.
So a word on the nature of the market here. So clearly it's rather volatile and it's reliant upon the demand of the users, often the borrowers in a credit protocol. So in the left-hand side graph, you can see here the blue line, which is the revenue going to the liquidity providers, the lenders, if you like. And this is correlating very closely with the yellow bars, which is the number of new users coming in. And the right-hand side graph is a case study of the compound protocol, which shows the lending rates on the left and the total value locked in the protocol on the right. And so you can see for one that the lending rates can get very high. So you're getting an 11% annualized rate on your Tether in February 2021. And also the interest rates correlate quite heavily with the total value locked. So it's quite a momentum-driven market. And I think what's driving users in there is their desire to speculate on the value of crypto assets. So it's not really about funding the real economy.
So I agree with the business conclusions on DeFi and crypto. It's not the basis for the future monetary system. There's problems on accountability, efficiency, and integrity. But there are some features that are being pioneered within DeFi, and they may have a useful function in the future. For example, this programmability, composability, and tokenization. So we should stay open to taking on board such innovations to the extent that they can add value.
That we have this new technology coming up, and this technology, we can see it and we can touch it on the one side through the tokenization of assets, including currencies, and distributed ledger technology. But this phenomenon lives in two different environments: the public sector, secondary legislation, MiCAR, and the private sector, and the public sector with the digital euro and the primary legislation directly embedded into the treaty. And this is a tension which we see is not easy to solve, because we don't really, we still have to understand how the digital euro will fit into the network of the MiCAR provision and the service providers for digital currencies, and including stable coins regulated by MiCAR.
What would you say is the role of banks in this envisaged system of blending crypto ecosystem and traditional finance?
the future of the monetary system will still be based on in central banks and the two-tier system, but needs to use this technological advance to meet new demand of household and firms. As for banks, banks will continue to have a crucial role in the system under different dimensions. So if CBDCs have a limited financial footprint, the disintermediation problem will be limited, and banks will offer probably CBDCs on their own app. In particular, banks could provide tokenized deposit and have a great role in porting trust in DeFi and Web3. Banks will probably ally with the fintech firms and especially big techs that have a greater comparative advantage on the use of artificial intelligence. Banks will continue to provide lending using more machine learning and data that we have to study and to understand.
What would you say is the applicability of the existing legal framework and enforcement when considering the regulatory aspect?
Filippo's on the right track that it's important to make the maximum use of the legal framework that exists today. And I think that there's still more that can be done probably to max this out so that this can be used to capture the parts of the crypto and a DeFi space which are sort of deliberately trying to hide from the obligations that actually already exist. But I think that we also need to be open to innovating in the way that we regulate and supervise